Welcome back to the Longacres Finance channel. It's time to take a look at the best dividend growth stocks that I am considering during the month of November. I have decided to trim this monthly watch list from the original 30 stocks to just the top 15. I believe this is a more digestible number of stocks, and it will allow me to provide you with more information about each of them. If you enjoyed the video, please give it a thumbs up, and subscribe to my channel so you don't miss any future content. Alright, in this episode I will present the top 15 dividend growth stocks that passed all of my filters. I will go over past performance in detail, as well as the drivers of alpha, and we will take a look at how a buy and hold strategy for this watchlist is performing. Let's jump right in with the list for November. The top picks this month are Charles Schwab with a 0.89% dividend yield. Based on dividend yield theory, the stock appears to be about 14% overvalued right now. Schwab is one of the best dividend growers out there, with a 24.57% 5-year dividend growth rate. The company also has a very low payout ratio of about 21%, which means there is plenty of room for future dividend increases. Even with this potential current overvaluation, my return forecast for Schwab is a 19.31% annual total return over the next 5 years. This is a combination of forecasted earnings growth, a return to fair valuation, which in Schwab's case implies a drag on the total return, and a pretty low current dividend yield. Schwab has been on the watch list for the past 9 consecutive months, offering a total return of 60.5%, making it one of the best watchlist stocks. Next this month we have Lam Research with a 1.08% dividend yield. Based on dividend yield theory, the stock appears to be potentially about 19% overvalued right now. It has a phenomenal dividend growth history with a 5-year dividend growth rate of 33.3%. The payout ratio is a very low 18%, leaving plenty of room for future dividend increases. My return forecast for Lam Research is 17.47% total annual growth over the next 5 years. The stock has been on the watch list for 8 out of the last 9 months, with a total return of 19.69%, which is pretty decent. Next this month we have Applied Materials with a 0.73% current dividend yield. Based on dividend yield theory, the stock appears to be potentially 47% overvalued right now. That's a pretty high overvaluation, but my return forecast is still pointing to a 19.66% total annual return for this stock over the next 5 years. The company has a solid dividend growth history with a 5-year dividend growth rate of 16.54% and a very low payout ratio of about 16%. The stock has been on the watch list for the last 9 consecutive months with a total return of 42.09%. Making it one of the better watchlist stocks. Next we have United Healthcare with a 1.28% dividend yield. Based on dividend yield theory, the stock appears to be about 8% overvalued right now. It has an excellent 5-year dividend growth rate of 24.19% and a low payout ratio of about 24%. My return forecast is pointing to 13.36% total annual growth for UNH over the next 5 years. The company has been on the watch list for the last 9 consecutive months with a total return of 39.53%. Next we have Lowe's with a 1.38% dividend yield. Based on dividend yield theory, the stock appears to be about 15% overvalued right now. It has a strong 5-year dividend growth rate of 17.14% and a very low payout ratio of about 25%. My return forecast is estimating a 16.19% total annual return for Lowe's over the next 5 years. Lowe's has been on the watch list for 13 out of the last 14 months with a total return of 15.93%. This rate of return is slightly worse than the overall market during this time period, but I expect Lowe's to be a strong performer in the future. Next we have Morgan Stanley with a 2.75% dividend yield. Morgan Stanley is the highest yielding stock on this month's watch list. It is also the most potentially undervalued stock on the list with about a 28% current undervaluation. The company has an excellent history of dividend growth with a 5-year dividend growth rate of 20.55% and a very low payout ratio of about 13%. My return forecast is pointing to a 16.88% total annual growth for Morgan Stanley over the next 5 years. The stock has appeared on the watch list for 4 out of the last 5 months with a total return of 8.68%. Next we have Texas Instruments with a 2.46% dividend yield, the second best dividend yield this month. Based on dividend yield theory, the stock appears to be about 4% undervalued right now. It has a great 5-year dividend growth rate of 21.59% and a good payout ratio of about 52%. My return forecast is estimating 13.23% total annual growth for the stock over the next 5 years. The company has been on the watch list for the past 9 consecutive months with a total return of 15.12%. Next we have Humana with a 0.61% dividend yield. Based on dividend yield theory, the stock appears to be about 3% overvalued right now. It has an excellent 5-year dividend growth rate of 21.75% and a very low payout ratio of about 14%. My return forecast for Humana is pointing to a 13.28% total annual return over the next 5 years. The company has been on the watch list for the last 8 consecutive months with a 22.62% total return. Next we have MasterCard with a 0.52% dividend yield. Based on dividend yield theory, the stock appears to be about 5% overvalued right now. MasterCard has a strong 5-year dividend growth rate of 20.11% and a low payout ratio of about 24%. My return forecast is pointing to 26.75% total annual growth for the stock over the next 5 years. The company has been on the watch list for 13 out of the last 14 months with a total return of 9.92%. I am certainly expecting better results from the stock in the future. Next we have T. Rowe Price with a 2.12% dividend yield. T. Rowe is one of the 3 stocks this month to offer a 2% plus dividend yield. Based on dividend yield theory, the stock appears to be about 18% overvalued right now. It has a decent 5-year dividend growth rate of 11.6% and a low payout ratio of about 32%. My return forecast is estimating 14.53% total annual growth for the stock over the next 5 years. The company has been on the watch list for 13 out of the last 14 months with a total return of 57.31%, making it the 4th best overall stock on the watch list. Next we have West Pharma with a 0.16% dividend yield. They are more of a total return play since you're not getting much of a yield here. Based on dividend yield theory, the stock appears to be about 66% overvalued right now. It has a rather poor 5-year dividend growth rate of 7.63% and a very low payout ratio of about 12%. My return forecast is estimating 16.8% total annual growth for the stock over the next 5 years. West Pharma has been on the watch list for 12 out of the last 14 months with a total return of 20.58%. Next we have Nvidia with a 0.07% dividend yield. Again, this is more of a total return investment since the dividend yield is so small. Based on dividend yield theory, the stock appears to be about 76% overvalued, but that hasn't stopped its strong market performance. It has an okay 5-year dividend growth rate of 10.13% and a very low payout ratio of about 6%. My return forecast is pointing to 20.72% total annual growth for the stock over the next 5 years. Nvidia has been on the watch list for 3 out of the last 7 months with a 28.43% total return. Next we have Activision Blizzard with a 0.6% dividend yield. Based on dividend yield theory, the stock appears to be about fairly valued. Of course my figures are from month-end October, and if any of you follow Activision stock, you probably already know the share price dipped heavily in early November. I think that only makes the stock more attractive. It has a good 5-year dividend growth rate of 12.26% and a very low payout ratio of about 14%. My return forecast is estimating 14.5% total annual growth for the stock over the next 5 years. Activision has been on the watch list for the last 6 consecutive months with a total loss of 14.25%. It's definitely one of the worst performing watchlist stocks thus far, but I think in the long run the company will bounce back and offer strong returns to patient investors. Next we have Amphenol with a 1.06% dividend yield. The stock is making a comeback to the watchlist after a 3-month break. Based on dividend yield theory, it appears to be about 19% undervalued, making it the 2nd best valuation margin this month. It has a good 5-year dividend growth rate of 14.43% and a very low payout ratio of 17.66%. My return forecast is estimating 19.21% total annual growth for the stock over the next 5 years. The company has appeared on the watch list for 3 out of the last 9 months, with a total return of 12.2%. And the final stock on the watch list this month is Monolithic Power Systems, with a 0.46% dividend yield. Based on dividend yield theory, the stock appears to be about 43% overvalued right now. It has a strong 5-year dividend growth rate of 20.43% and a good payout ratio of about 53%. My return forecast is estimating 18.12% total annual growth for the stock over the next 5 years. The company has been on the watch list for 4 out of the last 8 months with a total return of 9.48%. The average dividend yield for all 15 stocks on the watch list this month is 1.08%. On average, they are about 18% overvalued right now. The average dividend growth rate during the last 5 years is slightly over 18%. And the average expected annual return is 17.33%. Not a bad mix of stocks this month if you ask me. Let's take a look at past performance now. October was the 14th month for the watchlist, and the results were very good. The watchlist for October returned 8.52%. The fairly valued and undervalued stocks from the watchlist returned 8.59%. Both beat their benchmark, Vanguard's Dividend Appreciation ETF, ticker symbol VIG, that had a return of 6.93%, and both beat SPY that returned 7.02%. October was a great month for the watchlist, as it locked in its 2nd highest historical monthly return. The only better month was November of 2020, when the watchlist tacked on a cool 10.74%. I'd be very happy with the repeat performance this November. On a year-to-date basis, the watchlist is up 26.59%. The fairly valued and undervalued stocks are up 30.04%. VIG is up 17.8%, and SPY is up 23.86%. So the watchlist is beating VIG by 8.79% and SPY by 2.73%. And the fairly valued and undervalued stocks are doing about 3.5% better. Since inception, which was September of 2020, the watchlist is up 34.54%. The fairly valued and undervalued stocks are up 38.87%. VIG is up 28.52%, and SPY is up 33.9%. Comparing these returns on an annualized basis, the watchlist is beating SPY by about 0.5% with a 28.95% annualized rate of return, and it's beating VIG by almost 5% on an annualized basis. I am fully expecting this high annualized rate of return to fall in the future, as I think the past 14 months have been better than average. Let's talk about the drivers of alpha now. These are the stocks that helped the watchlist beat its benchmark and SPY last month. The best performing stock last month was Nvidia with a 23.42% gain. One additional stock topped 20%. That was Intercontinental Exchange with a gain of 20.59%. 12 more October watchlist stock finished last month with a double-digit return. They were Cintas with a gain of 13.78%, Home Depot with a gain of 13.25%, Humana with a gain of 19.02%, Intuit with a gain of 16.18%, Lowe's with a gain of 15.68%, Moody's with a gain of 13.81%, Microsoft with a gain of 17.63%, Charles Schwab with a gain of 12.62%, Sherwin-Williams with a gain of 13.18%, Thermo Fisher Scientific with a gain of 10.81%, T. Rowe Price with a gain of 10.26%, and United Healthcare with a gain of 17.85%. Now, not all the results for October were pretty. We had a total of 5 stocks finish the month in the red. They were Lockheed Martin with a 3.7% loss, Lam Research with a 0.98% loss, MasterCard with a 3.38% loss, MarketAxess Holdings with a 2.86% loss, and Visa with a 4.93% loss. The best performing stock on the watchlist thus far has been MSCI, with a total return of 79.38% over the full 14 months. Number 2 has been Intuit, with a 70.93% total return over 13 months. And number 3 is Charles Schwab, with a 60.5% total return over 9 months. Let's have a quick look at how the buy and hold strategy worked out in October. A buy and hold portfolio for the entire watchlist returned 7.75% in October, beating VIG. The buy and hold portfolio for the fairly valued and undervalued stocks returned 8.4% last month. Both buy and hold portfolios are beating VIG on a year-to-date basis and since inception. The buy and hold portfolio for the watchlist is up 27.64% this year, placing it a little bit over 1% ahead of the watchlist return. Since inception, it is up 35.54%, which is exactly 1% better than the watchlist. The fairly valued and undervalued buy and hold portfolio is performing about the same as the watchlist buy and hold portfolio. It is up 26.31% year-to-date and 35.72% since inception. So the fairly valued and undervalued stocks have performed a few percentage points better than the buy and hold portfolio. During the past 14 months, the watchlist has beat VIG for only 7 of them. It's not all about beating the benchmark. The margin of outperformance matters as well. Additionally, during periods of market downturns, having a smaller loss plays a significant role. I would argue that it may be better to outperform during negative return months than positive return months. I may analyze this type of performance data in the future to give you a better idea of how the watchlist is able to offer alpha. Before we wrap up here, I'd just like to mention that the return forecasts I presented are based on several assumptions, and they should be viewed just as an assumption, and not be the sole driver of your investing decisions. That's it for today. Thank you for watching, don't forget to subscribe, and see you next time.